Welcome to the deep dive. We're here to take complex information, unpack it, and really help you get well-informed on important topics. And today, we're embarking on let's call it a provocative journey right into the heart of modern finance and power structures. Our source material for this deep dive is a pretty comprehensive work. It offers a very, very specific, critical view on the Federal Reserve System and related institutions. We're digging into The Creature from Jekyll Island by G. Edward Griffin. Now, our mission today is to explore the claims, the historical accounts presented in this source. We want to help you understand its arguments, the connections it makes. Just to be clear, our role is guiding you through what the source says, highlighting its specific claims. We're not here to endorse any particular viewpoint, just to understand the arguments as they're presented.
Exactly. And this book, it promises to turn what, let's face it, can seem like a dry subject into, and I'm quoting here, an exciting drama which profoundly affects our lives today. We'll look at the concepts, the principles it lays out, and then tie them into historical events. So yeah, let's start this adventure. Let's understand the origins of what the source calls the creature.
Okay, so the source kicks things off by setting the stage, talking about a series of financial panics. Late 19th, early 20th century, 1873, 1884, 1893, then 1907. Now, usually people talk about flaws in the system, but what does this source say was the root cause of all that economic chaos?
Well, what's really fascinating, or at least what the source argues, is that these panics weren't really about a weak system. They were about weak banks, individual banks. It talks about currency drains, on banks that were loaned up, basically operating with almost no reserves. It argues that reckless lending policies were the real reason they kept failing, which, immediately raises the question. If the banks were the problem, what kind of solution were people actually looking for? Or perhaps certain people.
Right, and that's where this figure, Paul Warburg, comes into the picture. The source portrays him as a really persuasive guy, advocating strongly for a central bank in America. It mentions his pamphlets, things like defects and needs of our banking system. So what was his core argument? What did he say America needed?
Well, connecting this to the bigger picture the source paints, Warburg argued for what he called an elastic money supply, meaning the ability to expand or shrink the amount of money circulating, not being stuck with just the gold supply or, limited government bonds.
So flexibility, more control over the money supply itself.
Exactly. And this idea, it really set the stage, intellectually speaking, for what was about to happen.
Which leads us straight to that very secretive meeting in 1910 on Jekyll Island. The source paints this vivid picture, doesn't it? A private railway car, the Eldritch, somehow distinct from its dull brothers, and this distinct aroma of expensive cigars. Who exactly was Nelson Aldrich? And who else was gathered there in secret?
Yeah, the secrecy is a huge point in the book. It says there were 7 men there. You had Senator Nelson W. Aldrich.
Political player, right. Republican whip, head of the National Monetary Commission.
And not insignificantly, John D. Rockefeller Jr.'s father-in-law.
Oh.
And Paul Warburg was there too, of course. The source claims these men represented, get this, an estimated 1/4 of the total wealth of the entire world.
Wow, 1/4. Why all the secrecy then?
Well, that's the million-dollar question, isn't it? The source is pretty blunt. It asserts their main goal wasn't just general financial stability for everyone. It argues they wanted to create a national cartel, one dominated by the bigger banks. And crucially, a cartel designed to get the federal government involved in shifting the inevitable losses from the owners of those banks to the taxpayers.
Shifting losses.
Uh-huh.
So privatize profits, socialize losses. Is that the idea?
That's exactly the interpretation the source puts forward, that this was baked in from the start, a mechanism for the banks to protect themselves, ultimately at public expense.
Okay, so we've seen the context, the alleged secret origins. But to really grasp the power the source attributes to this creature, we need to understand how it claims money itself is created. The book has this provocative Q&A section. It asks, basically, do banks even have any real money? And the answer it gives is, theoretically. What does that imply about money in the system described?
Right, and this is where it gets really fundamental, according to the source. It digs into the mechanics of money itself. It contrasts historical commodity money, gold, silver things with intrinsic value, certified by the state, with systems where governments would debase the currency, water it down, basically.
Leading to price rises, inflation.
Exactly. The source even throws out this line, gold is the enemy of the welfare state. The implication being that real physical money limits government spending power. And getting back to your question about banks, the source argues, yeah, theoretically, they don't hold all the deposits. They create new money through the act of lending.
And the book introduces this specific term for how the Federal Reserve allegedly does this, the mandrake mechanism. It says it's quite simple, like the old goldsmiths, who issued receipts for gold they didn't always have, but without even needing the gold. So how does this machine, as the source calls it, actually work? What's its function?
Yes, the mandrake mechanism. The source breaks it down, saying its entire function is, simply put, to convert debt into money. That's the core idea. It explains that the Federal Reserve takes government bonds debt that maybe the public isn't buying.
Okay.
And essentially writes a check to Congress for them. But crucially, the source claims this check isn't backed by pre-existing money. It's fiat dollars created right there on the spot.
Created out of nothing.
That's the assertion. Then, these bonds are labeled reserves. And here's the kicker, according to the source. The Fed uses these reserves as a base to create 9 additional dollars for every $1 created for the bonds themselves.
9 times multiplier.
Roughly, yes, through the fractional reserve system. The initial money goes to the government to spend. But those extra $9, they become the pool of money that banks can then loan out, so the money supply expands significantly.
Okay, so if that's how it works according to the source, what does that mean for, the average person? The book calls it a printing press effect, but based on an accounting trick. It talks about a perpetual override for this banking cartel and unlimited funding for Congress. And it suggests voters don't even realize their taxes are being raised through the process of inflation. How does that work?
Well, the argument is that when new money is created like this, without a corresponding increase in goods and services, the value of every existing dollar goes down. That's inflation. The source likens it to a hidden tax. It's not explicitly voted on like income tax, but it silently erodes your purchasing power, transferring wealth away.
Like that Monopoly game analogy it uses,
Yeah.
where the banker is also playing and ends up owning everything.
Exactly. It frames inflation as this stealthy confiscation, and politically. Much easier than raising direct taxes, the source argues, precisely because few people understand how it works.
The book gives a historical example too, doesn't it? The Continentals. During the American War for Independence, what happened there? And what did the Founding Fathers supposedly learn from it about bills of credit, paper money?
Oh, yeah, that's a stark example in the source. It says in 1775, a continental dollar was worth about $1 in gold. Pretty standard. But by 1779, just 4 years later, it was worth less than a penny. A 5,000% expansion of the money supply, the source claims. Hyperinflation, basically.
Wow.
George Washington himself is quoted, "A wagon load of money will scarcely purchase a wagon load of provisions." That's how bad it got.
So what was the takeaway for the founders, according to this book?
The source emphasizes that they learned a bitter lesson. It claims that when drafting the Constitution, they deliberately removed a clause that would have allowed the legislature to emit bills of credit, essentially, to print paper money not backed by anything. It even quotes Alexander Hamilton arguing against it, calling it an engine of imposition and fraud. So the source suggests the founders were initially very wary of exactly the kind of system we have now.
Okay, moving on to another major theme in the source. Bailouts. It makes this really strong claim that the name of the game is bailouts.
Yeah.
And that this wasn't just something that happened occasionally, but a primary objective right from the Fed's creation. How does it argue this idea of shifting losses to taxpayers was actually part of the design?
The core argument is that the system, as designed according to the source, inherently externalizes risk from the big banks onto the public. It wasn't an accident, it was a feature. And the book provides a whole list of examples to back this up. You mentioned Penn Central Railroad in 1970.
Right.
The source alleges banks loaned them money, maybe pushed them deeper into debt, then sold off their stock before the collapse, and then the Federal Reserve steps in, orchestrates government subsidies, loan guarantees about $125 million, ensuring the banks got their money back, even though the railroad itself failed.
So the banks were made whole, but the company wasn't?
That's the pattern the source points to. Transferring the risk, transferring the loss.
And it wasn't just Penn Central. The source mentions Lockheed in 1970, getting $250 million in loan guarantees. Commonwealth Bank of Detroit in 72. Getting loans and guarantees protecting banks like Chase Manhattan. But the really big one, the one the source seems to hold up as the ultimate example, is Continental Illinois in 1984. What's the story there?
Ah, yes, Continental Illinois. The source calls that the bailout of the century. It was huge at the time. It faced collapse, mainly due to bad loans in the oil and gas sector, plus exposure to the Mexican and Argentine debt crises. Things looked dire.
So what did the Fed do?
According to the source, the Fed opened its discount window wide. That's its emergency lending facility for banks. Then the government stepped in with a massive $4.5 billion package. This effectively meant the government took 80% ownership of the bank. The source explicitly calls this nationalization, even if nobody used that word publicly at the time.
So nationalization to save a private bank's creditors.
That's the implication. And the source stresses that all the money for this and other bailouts came from the Fed acting as the lender of last resort. And it repeats the core claim: this money is created out of nothing, which results in confiscating wealth through that hidden tax, inflation.
This pattern, the source argues, continued into the savings and loan crisis of the 1980s. It describes a perfect storm. Government deregulation combined with Federal Reserve policies that pushed interest rates way up. This led to widespread S&L failures, fraud. The source even alleges mafia and CIA involvement in some cases. What was the final bill for the American taxpayer from that whole mess?
Well, connecting this to the bigger picture, the source points to legislation like the HRREA. Initially, it authorized something like $300 billion, but that figure kept climbing, later revised to $500 billion, maybe even more, according to some estimates cited, all to be covered by taxes and, again, inflation stretched out over 30 years, all to safeguard and stabilize the system.
$500 billion back then. That's enormous.
It's staggering. The source portrays the S&L industry itself as a kind of cartel within a cartel. It argues it could only function because Congress had access to unlimited amounts of money from the Fed to borrow against. And there's an interesting side effect mentioned. Government housing programs meant to help people actually ended up driving prices higher because of all this created money, and inflation wiped out the value of people's down payments. A cruel irony if the source is correct.
So the effects ripple outwards. But the source claims the ambitions of this system go even further, beyond just domestic finance. It looks internationally. It talks about institutions like the IMF, the World Bank, created at Bretton Woods in 1944. Officially, they're about facilitating trade, promoting stability. But what does the creature from Jekyll Island claim was their real purpose, their hidden agenda?
Yeah, this is where the scope gets really global. The source asserts that the founders of the IMF and World Bank didn't just see them as economic tools. It claims they viewed them as instruments for social and political change, and specifically, the source alleges, for building world socialism.
World socialism. How would loans achieve that?
Well, it points to things like structural adjustment loans. These weren't necessarily tied to building a specific dam or road. They were tied to demanding policy changes within the borrowing country. The source suggests local politicians could then implement unpopular socialist-leaning policies, but blame it on the big bad capitalists from America and the IMF, shifting the blame, potentially causing unrest.
It gives examples.
It does. It cites the Ethiopian famine, claiming the World Bank actually funded the very government agency responsible for a brutal resettlement program that the source calls a starvation program. A really shocking and controversial allegation about the real-world impact.
So if these institutions are seen this way by the source, as tools for change, how does it connect them to this idea of a world central bank? One with a power to issue a global fiat currency, something like the banker that was discussed historically. What's the strategy the source alleges?
The argument laid out in the book is that economically strong, independent nations aren't likely to just give up their sovereignty, right?
Makes sense.
So the alleged strategy is to use loans. Loans, the source claims, are never intended to be fully repaid, to direct this massive transfer of wealth towards less developed nations. The idea, according to the source, is to weaken all nations, including the initially strong ones, through this drain. Eventually, everyone becomes dependent, everyone needs assistance.
And
at that point, they'll be more willing to accept the loss of sovereignty in return for international aid, to join a global system managed by a world central bank issuing a world currency. The source even highlights a quote attributed to President Reagan in 1983, suggesting an integrated world economy needs a common monetary standard and that only a world currency will work.
And Nixon taking the U.S. off the gold standard in '71 is seen as a key step down this path.
Exactly. A necessary precondition, according to the source's narrative, for a future global fiat currency.
Okay, this next connection the source makes is perhaps the most explosive. It links all these financial mechanisms directly to instigating wars. It argues that monetary control is the weapon of choice in the New World Order, because it's precise, it's powerful, and critically, it's seldom understood by its victims. People don't realize how it's being used against them. How does this source make this leap? What historical examples does it use to tie finance to warfare?
Well, connecting this to historical events, the source puts forward some very controversial interpretations. It claims, for instance, that European powers actually wanted the U.S. to get bogged down in the Civil War.
Why?
To weaken America so they could potentially ignore the Monroe Doctrine and recolonize parts of Latin America, a geopolitical motive tied to weakening a rival. And its account of the U.S. entry into World War I is particularly detailed and, again, highly controversial.
The Lusitania incident.
Yes. The source insists the Lusitania, a passenger liner, was secretly carrying large amounts of munitions. It claims the ship's captain even resigned over it, not wanting the responsibility of mixing passengers and contraband. It also states the German embassy tried to warn American passengers by placing ads in newspapers, but that the U.S. State Department suppressed most of them.
And President Wilson knew.
The source alleges Wilson was informed about the risks and the cargo, but did nothing. Furthermore, it claims British leaders, especially Winston Churchill, who was First Lord of the Admiralty, deliberately plotted the destruction of the ship specifically to outrage American opinion and drag the U.S. into the war.
That's a huge accusation against Churchill and Wilson.
It is a very serious claim about manipulating events to achieve a desired political outcome using finance and warfare together.
And the source doesn't just talk about politicians. It names specific financial players. The Rothschild dynasty gets mentioned with that famous, perhaps apocryphal quote from Mayor Amschel Rothschild, "Let me issue and control a nation's money, and I care not who writes the laws." It also suggests J.P. Morgan's powerful firm, despite its American image, was actually more British in orientation and possibly even a secret Rothschild agent. How does the source then connect these powerful financiers to what it calls financing enemies? That seems counterintuitive.
It does seem counterintuitive, but the source presents it as part of a larger, more cynical strategy. It details, for example, a group of New York financiers who went to Russia right after the Bolshevik Revolution.
Under what guise?
Ostensibly as a Red Cross mission. But the source alleges their real purpose was to support the Bolsheviks, establish connections, and gain profitable business concessions from the new regime, influencing Lenin himself. It even mentions a J.P. Morgan cable authorizing a $1 million transfer to the mission's head, William Boyce Thompson, who was also a Federal Reserve Bank director.
So, supporting the communists for profit.
And potentially for geopolitical reasons, according to the source. It goes on to assert that major American and European corporations it names, Standard Oil, General Electric, even IG Farben in Germany, whose factories were allegedly spared. Allied bombing continued to provide crucial goods, technology, and capital to the Soviet Union and later to Communist China.
Why would they do that, according to this view?
The source argues this economic transfusion keeps these socialist regimes afloat. It suggests that having credible enemies is actually essential for those who seek global control. It provides justification for military spending, for international alliances, for interventions.
So conflict is profitable or strategically useful.
That's the grim conclusion the source draws. It states flatly that the Federal Reserve System, by enabling this kind of large-scale finance and debt creation, ultimately encourages war.
Okay, let's bring it back to the Fed itself today. The source describes it as a hybrid entity, not quite government, not quite private. What does it mean when it calls the Fed a cartel protected by federal law? How does it justify that description?
Well, it raises the point that while the member banks technically own stock in the regional Federal Reserve banks, this stock doesn't really grant them control in the way normal stock does. There are no real voting rights attached, apparently. The real power, day to day, lies with the Board of Governors in Washington, who are appointed by the president and confirmed by the Senate.
So it seems governmental in that respect.
Yes, but the source argues the Fed is deliberately structured to be independent of direct political control. Congress could theoretically abolish it, but short of that, it operates with significant autonomy. So the source concludes it's essentially an association of the large commercial banks that has been granted these unique special privileges by Congress, hence a legally protected cartel.
The source also makes this rather alarming claim that the Federal Reserve System is the biggest doomsday mechanism of all. Why? Because if the national debt were ever actually paid off, the entire money supply, which is based on that debt, would collapse.
Right, it's built on debt. If the debt disappears, the foundation of the money disappears, according to this model, a catastrophic deflationary spiral.
And it connects this financial mechanism to other forms of societal control. It mentions political environmentalism being used as a substitute for war, another way to frighten people into accepting lower living standards and more government control.
Yes, it weaves these threads together, suggesting different mechanisms, financial, political, social, are used towards a similar end of centralized control.
So given this incredibly critical, even damning assessment of the entire system, what does the source propose as a way out? What are the solutions offered?
Well, connecting this to the way forward, the source doesn't mince words. It calls for pretty drastic steps. First, abolish the Federal Reserve System as a central bank entirely. Let it exist perhaps only as a national check clearinghouse, but without any government subsidies or special status.
And banking itself.
Introduce free banking. That means significant deregulation, but crucially, also ending taxpayer bailouts. Phase out the FDIC and other government deposit insurance schemes. Let banks succeed or fail on their own merits.
That sounds risky for depositors.
Well, the source pairs this with a fundamental change, requiring 100% reserves for demand deposits, like checking accounts. If you deposit $1, the bank has to hold that dollar. It can't lend it out. You'd likely pay a fee for the service, like a safety deposit box, but your money would be physically there.
And savings accounts or time deposits?
Those would be treated differently. They would be explicitly understood as investments. The bank would loan that money out to earn interest, sharing it with the depositor, but the depositor would know the risks and the time frame involved. A clear separation between safekeeping and investment.
And the core of all this seems to come back to the nature of money. The source strongly advocates restoring commodity money, gold and silver. It suggests figuring out the value of the government's gold and silver holdings, calculating the real backed value of every Federal Reserve note, and then actually exchanging them. Why is going back to gold or silver seen as so critical?
Because the source's fundamental argument is that inflation, enabled by the current fiat system, isn't just an economic phenomenon, it's a moral one. It's a hidden tax that leads to the confiscation of property. It throws out a startling calculation. Over a typical 45-year working career, the hidden tax on your saved dollars due to inflation could effectively wipe out 90% of their original value.
90%, that's almost everything.
It's a powerful claim. So, for the source, the only real way to protect yourself from inflation isn't finding clever investments to try and keep pace. It's to stop it entirely by returning to a system where money can't be created arbitrarily.
And how to achieve such a massive change.
The book concludes that the best investment isn't gold or silver itself, but an educational crusade. It argues that the current situation persists because Americans have allowed their nation to be stolen from right under their noses because they did not understand what was happening. Knowledge is the key, according to Griffin.
Wow. Okay, so our deep dive today into the creature from Jekyll Island has certainly taken us through a sweeping and highly critical narrative, from those alleged secret origins of the Fed, through its mechanics of money creation, the patterns of bailouts, these claims of global ambitions tied to a new world order. We've explored some really challenging claims about hidden agendas, powerful financiers, and how economic systems might be, well, manipulated according to the source.
It really does highlight a profoundly critical perspective, doesn't it? Suggesting that many of the economic challenges we see aren't just accidents or mistakes, but that they might be, in fact, inherent features of the system itself, a system the source claims is designed primarily to benefit a select few.
So as you, our listeners, reflect on everything we've unpacked today, here's a final provocative thought to consider, drawn from the source's own emphasis. If, as this book suggests, knowledge is most valuable when understood and applied, and if the very nature of money, how it's created and controlled, truly affects our lives so profoundly, what responsibility do you feel you have to dig deeper, to understand the actual workings of the financial systems governing our world, maybe beyond the standard explanations? What would it really take for us as a society to truly grasp the meaning and mechanics of money?
A challenging question. What really stands out to you from this deep dive today?